Thank you for coming back to Decoded Fin. This is where we translate finance into plain English so everyone can understand how money really works. I'm Jesse, and today we're going to dive into the financial systems, things like the banks, markets, and rules that make modern business possible. I want you to think of financial institutions as the economy's matchmakers. So on one side, we have people who save more than they borrow, so households or individuals. And on the other side, we have businesses and governments who almost always borrow more than they save. Financial institutions take the savings of millions of people and turn them into loans and investments that help companies grow, hire, and innovate. And you may ask yourself, why does this matter, right? Well, when these institutions are healthy, money flows easily. Companies can borrow, expand, create jobs. But when big institutions get into trouble, like we've seen before, the flow of money slows down. Suddenly, businesses can't get financing, and the entire economy can feel the pain. This is why financial stability isn't just a banking issue, it affects jobs, growth, and everyday life. So financial markets are a little different from financial institutions. Instead of going through a bank, companies and governments can raise money directly from investors by selling stocks and bonds. They provide a forum where savers and borrowers can transact without having to go through a bank. So here's the simplest way to understand it. We have the primary market. This is where securities are sold for the first time. For example, a company issues a new stock or a bond to raise money. Then we have the secondary market. This is where investors trade those securities with each other. Think of, the stock market. This is all secondary trading. Companies only raise money in the primary market, and everything else that is investors trading among themselves. The money market is about short-term needs, so usually less than 1 year. It's where savers park cash temporarily and borrowers get quick funding. Some examples of this are treasury bills, commercial paper, certificates of deposit. Internationally, we have what's called the euro currency market, and this works the same way as the money market, just across borders. So these securities then trade in secondary markets, either a broker or a dealer market. The capital market is for long-term financing, the kind companies use to build new factories, expand operations, develop new product lines. Some instruments for being able to finance a company long-term are through bonds or stocks. Bonds is long-term borrowing, and stocks is essentially giving a slice of ownership in a company in exchange for funds, and these securities trade in the secondary market. One of the most important jobs of the capital market is figuring out what a company's securities are actually worth. In an efficient market, the price of a stock or a bond is the best unbiased estimate of its true value, right? So based on all the information investors have. Because financial institutions affect everyone, governments regulate them to keep the system stable and able to protect the public. The following is a brief timeline of the major regulations in finance. Number one, we have the Glass-Steagall Act in 1933, and this essentially created the FDIC and separated commercial banking from investment banking in order to limit risk. We have the Securities Act of 1933. This regulates the sale of securities in the primary market. We have the Securities Exchange Act of 1934, which regulates the secondary market trading and also created the SEC, the Securities Exchange Commission, the main cop on the beat for financial markets. We have the Gramm-Leach-Bliley Act of 1999, and this repealed much of the Glass-Steagall Act, allowing banks to combine commercial and investment activities again. And then the Dodd Frank Act of 2010. This passed after the financial crisis 2008 to tighten oversight of large financial institutions. Most companies don't start by selling stock to the public. They begin with private equity, so money from angel investors or venture capitalists who believe in the company's growth potential and often aim to eventually take the company public. When a company is ready to go public, it launches what's called an IPO, an initial public offering. Here are the steps that are taken when a company is ready to do that. So the company hires an investment bank to guide the process. That bank may form a selling syndicate with other banks to help distribute the shares. Number two, the company files paperwork with the SEC and promotes the offering to investors. Number three, the stock is then priced and sold in the primary market, and then after that, the stock trades freely in the secondary market. So I hope now, after listening to everything I said previously, you're able to understand that financial institutions and markets are the engines that move money from people who have it to the people who need it. They help businesses grow, help governments function, and help savers earn a return on their money. When the system works well and it's properly regulated, the entire economy benefits. If you're enjoying this series at this point and you want to keep building your financial fluency and understanding, hit like and subscribe and share this with someone who is passionate about understanding how money really works as well. Next up, we'll start decoding more specific topics in finance, and thank you for watching Decoded Fin.